Today we're going to be going over what liquidity is, how to spot liquidity, and the different types of liquidity there are in the market. So what is actually liquidity? Liquidity is the levels of swing high and swing low. So every swing high and swing low, there's liquidity resting below these levels. Reason being is because when the market puts in a new swing low, we always see a push up and a push back to take out stop losses. Stop losses are always put below these levels, like this. Retail traders take their stop losses, put it below these levels, in these levels. So what the market tends to do is we always see a push away and then a push to take out these stop losses and a continuation in the same direction. The reason why we see a push down to take liquidity out is so that we can have all the orders taken out. The bank doesn't want to fill in all the retail traders, so we take them out. Let me give you an example like this. So this would be our buy side liquidity, and this our sell side within the range of the market. So what the market does is we print the sell side level, push up, create buy side, create a pattern down, push, take sell side out, and then continue back up to buy side. Reason being is, like I explained before, we have retail traders taking buys at these levels to continue with the trend all the way up. But what the market tends to do is we take out these retail trader stop losses like this. So let me give you example on the chart of where to spot these liquidity sweeps. So this would be liquidity here, because we see the market pushed up, created buy side, we pushed low, created sell side on these swing points. You see how these swing points here? Swing high created, swing low created. So this would be considered sell side liquidity, and this would be considered buy side. So the way liquidity works is, if buy side is swept, we want to see displacement to the downside, because we're taking all the sell orders are being taken out by this candles here. All the sell stop losses are being taken out here. Can you see what I'm saying? All of the sell stop losses were taken out by this move up, because this was the swing high initially, and the stop losses will be put above the swing high. So once we take buy side out, we want to see a push down to sell side levels. And when we see sell side being taken out like this here, there will be maybe some buy orders, long term retail traders putting buy orders above here, stop losses above, below this level here. And what the market does is we push, take sell side out, and then push up. So this is how liquidity works. When buy side is taken out, alright, when buy side is taken out, we coming down. When sell side levels are taken out, we want to see a push up with an expansionary move. And then there is two different types of liquidity. There is, let me do this for you. There's two different types of liquidity. We have internal liquidity and we have external liquidity points. Internal will be within this range of the market. Internal will be within the inside of this range. External will be the highest high and the lowest low within the range. Like, let me give you example on the charts. This here would be considered external levels. This level here and this level here at the lowest point. Reason being is because you can see the market pushed down, created this low, pushed all the way up and created this level of external buy side, this level of external sell side as well. And this level here would be considered internal sell side liquidity. These levels here have equal highs. These would be internal levels. You see how the market pushed up, created these levels here of equal highs, pushed down, took out this level here of external. You see how the market always returns to take levels out. Sell side was taken out here, and now we're pushing up to take internal up. We took out internal buy side liquidity. And what happens when we take buy side out? We want to see a push to the downside. No, this time it didn't necessarily push all the way down to the sell side levels because the external wasn't taken out yet. You see what I'm saying? We always take out liquidity in the markets. We never leave liquidity laying behind. Then the market decided to make new levels of liquidity here. See how we created new lows? We considered the internal sell side again, because we created new equal lows that weren't taken out yet. These lows weren't taken out, so this is resting liquidity still. There's still orders below this liquidity. Retail traders took buys maybe here, and they had liquidity, their stop losses laying below here, and they took buys until maybe the swing high point here, or the swing high point up here. You see how the market always takes out external also. You see how the market pushed out, took out external, and then we continue to the upside. Okay, let me give you an example on the higher time frames. How liquidity is swept on every time frame, and how liquidity is always created. Okay, let me show you here. Here we have a level of buy side liquidity, right? All this here resting above would be considered an area of like orders where retail traders have their stop losses. All the resting liquidity above. So we see the market. Here's the buy side level, right? The market always pushes down, creates a sell side level. You see there we created external sell side levels, equal lows there, external sell side levels, pushed out, took out the external highs, took out the retail traders with their stop losses in these levels, and continued to take out internal levels. Can you see how the internal levels are swept? This major internal low on the daily chart was taken out. This level of sell side on the daily. We saw market push up, take this level of buy side out, take all the retail trader stop losses out, push down, take this level of lows out, all these lows here laying behind, and pushed up again because we swept sell side. Now what we can do with these levels being taken out is pair them with an entry model. So let's go down to a lower time, but this happens, I want to show you that this happens on all time frames, not just one. Internal and external levels are created on all time frames. Okay, here we have levels. We have a level of external that was created, right? External buy side, and then we had this level here of external sell side, and this level here of internal sell side. Remember that when retail traders take trades, they take the trades and put their stop losses below these swing points. Sometimes it doesn't push all the way down, but you will see that the market always does this. We always see a push below a level of liquidity and a push up away from liquidity. and it happened here again. We saw the external being created, a push up into this, taking it out, and then a push down into the internal buy side. This would be the internal buy side level. Internal sell side level. Sell side below, buy side above. Just remember that all the time. Buy side levels above, sell side level below. Every liquidity point is a swing point. So high, this would be liquidity. A low would be liquidity. These areas have a lot of wicks. These would be liquidity pools. A lot of resting liquidity that needs to be taken out, right? When we see a lot of liquidity like this, we're expecting the market to at least return into this level and take it out. And yeah, in this case, we didn't see that happening. But we did see our buy side level taken out there. This level, swept, taken out. And this level of internal, right, was taken out. Yes, madam. This level was taken out. Sell side level was taken out. Swept it and continued up. Buy side, buy orders were filled here. Stop losses above the buy orders. So we want to see the push above and a push below into sell side, so that you can see a movement up from the sweep. And when you're trading with liquidity, you never enter the market without using liquidity. It's the best confluence. So let me go and show you on another chart on a different currency pair. Here we do have gold. Gold created this range here with the external buy side here, the other external buy side on this side, and then there was levels of internal buy side laying on these levels here. Internal sell side, sorry. These are internal levels that need to be taken out. Because why? Retail traders have their stop losses below these levels, so that they can continue up with the market. What smart money concepts does is we want to see a fake low created, a push away from it, and then a return into the low so that you can get swept. And then from a sweep, we continue with the general direction of the market. Whichever way we sweep, we take it. And usually after a sweep, we see a creation, like after the sweep, we see a creation of a fair value gap. Always a fair value gap that's been created. Because the market sweeps, pushes up with a lot of volume, returns into a fair value gap, and continues up to the next level of liquidity, which would be this buy side. So what we can do as SMC traders is, we would have taken maybe some buys in this level here, stops below here, take profit on the next level. And this happens on every time frame. I can even show you on a 1 minute. Let's go down 1 minute. Okay, so here we had gold. This is the example here. We had gold creating this level of buy side liquidity, right? We always pair this with the higher time frame though. See how gold made the level, created a new level, pushed up, took the level out, right? This would be a sweep now because we already took the level out. People who bought here, stops above this level. Like I said, retail traders, stop losses above the level. They want to continue downwards all the way. But here the market fakes them out, stops them out with a liquidity sweep. And then we have the SMC traders, clear fair value gap created on a 1 minute. And then look at this return, perfect return into the fair value gap after a movement down. And now we want to see a expansionary move all the way to the new level of sell side liquidity. And you can catch trades like this just based off liquidity sweeps. Sometimes you don't even need a daily bias. I can even show you some examples on a 5-minute how liquidity is being created. So this is today's market. This would be our sell side level that was created. You see how the market pushed down, created this swing low level, and now it's consolidating. So maybe we're gonna see a sweep from this level, a push away from this level, and then a creation of a fair value gap. So I'm gonna show you guys how to enter off liquidity sweeps now. Let's go into the 15-minute with USD. Let's go back into a random point of the market. Let's see example. Okay, here we go. Here's a nice example. So what we had here was these lows were created. See how the market pushed down, created these lows, which means that retail traders took buys on these levels. Stops were below here, maybe somewhere there, took some levels out, and continued up after the sweep was happening. So after the sweep, what we're gonna look for is, don't look on the left side of the market. After the sweep happens, don't look to sell. Once the sweep happens, you see how the rejection plays out. Now we're gonna look for a continuation to the upside. So I can go down to the 5-minute quickly. We're gonna find that level. Okay, here we go on the 5-minute. See how we sweep this level, sweep, push away, return, sweep, and then continuation to the next level. Okay, let me show you. This here would be the candle that swept the liquidity, right? Because we saw lower and a push away. What we had here on the lower time frame was a break of structure to the upside, a market structure shift to the upside. Always look for a market structure shift after a sweep, right? See how the candle closes above this level here, would be a market structure shift. And then we had this small fair value gap created in this level where the sweep happened, the market structure shift happened, and then we saw a push back in where we could have taken some buy positions from this level, stops below these lows, and then maybe you just take a 1:2, something like that, 1:2, push up higher. So what we use for our entry model is a, let me draw it for you, sweep, so this is what would be our entry model, or for a buy model. Alright, this would be our sell side liquidity. Wanna see market push up away, taking the retail traders out, sweeping the liquidity, pushing up, making a break of structure there. As you can see, a break of structure was created right here. Break of structure was created. Alright, push into the break of structure. Now we can look for a fair value gap that was created somewhere here. I want to see market push into this fair value gap and take this level that was created out with the fair value gap, and we always catch it from the fair value gap. Take a trade like that. So we always wait for a sweep when we trading. Let me look for another example for you for our entry model. Here's another perfect example on a 5-minute. Here we have the market creating all these lows. This would be our level of sell side. We see a push away from this, a push back into this, taking all the retail traders out. Buy orders were filled here, continuation up, stops were below these levels. Smart money concept traders push the market up to fool the buyers into thinking the market's gonna continue up. Sweep of the liquidity, sweep of the buyer stop loss, and a continuation up, right? Now what we're gonna look for exactly after the sweep, right after the sweep, what we're gonna look for is a market structure shift, which happened right here. Market structure shift and a fair value gap to take the buys off of, right? Here we had the fair value gap, could have taken buys here, above there, and this would have been a little bit of a longer trade, right? Because the market moved a lot sideways. But you see how the fair value gap held this level. We never saw one move below the fair value gap in this whole range. You see how strong a liquidity sweep can make the market. Let me try and show you guys an example of a sell. Let's go to gold. 15 minutes. Let's go to a random time. Okay, I think here we have a sweep of liquidity. There we had the external level swept and the internal. Look, the internal level was created here. We had a sweep of the internal and external. Then we saw the market push to the downside, make a break of structure with this candle closure. This candle closed below this level, so which indicates it's a break of structure, right? Push above the buy side, sweeps it, takes out the stop losses of the retail traders, pushes below, makes a market structure shift, another market structure shift here, leaves us a fair value gap to take the sells off of. We could have taken it in this level, taken it to this level of external buy side, right? Take profit here, stops above the fair value gap. Beautiful trade there. Just from three things: a liquidity sweep right here, a sweep of liquidity, a market structure shift to the downside, a push back into the fair value gap, and a movement down. That's gonna be the lesson for today, guys.